So you're just gonna show him about the
Okay, so today's lesson will be on watching you.
All right. So what I like to teach people first when it comes to Forex trading is the two types of trends that they're generally in the market. So there's three trends, but I like to focus on two of them. So there's bullish trends, which is when the pair is predominantly going up, right? Mm-hmm. Then there's a bearish trend where it's predominantly going down. And this is how we make our money, right? So a bullish trend means it's going up, we want to buy. And a bearish trend means it's going down and we want to sell. And that's in order to make money. Mm-hmm. And what I like to teach people is...
How would you make money from the bearish trade?
So if you sell, like you can open up two orders, as I'm going to show you right here. Mm-hmm. You can do new order, right? So if you could do a sell by market or a buy by market, right? If you sell by market, that's basically saying, okay, I think this is going to go down. When it goes down, you make your profit. If you do buy, you're saying, okay, I think it's going to go higher up. And when it goes up, you make your money.
That makes perfect sense. I didn't think about that. Now it's clicking.
Yes. It's clicking. So the terminology that's used in the market is bearish and sell and short. What you would hear people say is go short. That means sell or do a bearish trade. Mm-hmm. Or if you hear go long, that means a bullish trend or buy. Mm-hmm. So how we make our money is I'd sell, like say up here, then it drops, it goes up a little bit, it drops down even further, mm-hmm. I make profit, I close that out. Mm-hmm. Or if I want to do a bullish trend or a long, I would buy down here, it would go up, come down a little bit, go up, come down, go up, and I'd make my money. Mm-hmm. So that's how the market works. That's how you make your money, right? And no, I'm not going to get into that right now. It's a little confusing. So the way that we can read the market is because of these things called candles. Candles is basically, it tells us a story. Each candle tells us a story. The formation of a candle is, there's two types of candles. There's a bullish candle, then there's a bearish candle. Okay. Just like with the bullish trend and the bearish trend. Mm-hmm. So a bullish candle, generally, it's going to open up right here at the bottom. You see where this line is? It opens up down here. It'll drop down to its lowest point, creating what's called the wick. Then it'll rise back up and go above where its open is to right here, creating what's called the body. That's the body of the trend, of the candlestick. And it'll go up to its highest point, and then it'll come back down, creating the close. And then the bearish trend is the exact opposite. It opens up near the top. It'll go up to its highest point, and then it'll drop down, creating the body. And then it'll go further, creating the lowest point, and then go back up to its close. So that's kind of generally how the candles like to move in the market. Mm-hmm. And based off of how the candle looks, it could tell us a different story. Mm-hmm. Like, for example, there's bearish engulfing. You have dojis, you have all these different candlesticks. And when you get farther and farther into like reading charts, you start to read about what these different candles mean, what they tell us what's going to happen in the market. And then you can also add on to that and learn and create your own strategy. Mm-hmm. So what I like to review with you is, what does a bullish trend mean?
So a bullish trend means that it's going up, mm-hmm. right? It means that you should. It also means long, mm-hmm. right? So that means you should buy at the lowest point and then sell at the highest point. Mm-hmm. A bearish trend is where it's the complete opposite, where it starts up at the top, mm-hmm. but the lower it goes, the more money you make, mm-hmm. right? And that's a short. Mm-hmm. Okay.
And an easy way to remember that is the two animals, bulls and bears. Mm-hmm. How do bulls attack? They put their horns up like that. Mm-hmm. How do bears attack? They swipe their paws down. Mm-hmm. So that's the way that I teach my students, just how to remember.
Dope,
yeah.
Dope.
So what you wanted to know was, how can you make an accurate trade?
Yes.
The easiest way to learn to make an accurate trade is to understand what structure is. Structure is basically how the market moves Because most people think, okay, the market just goes straight up. The market doesn't move like that. And that's how people tend to lose money, because what happens is this. The market will go up and the person will see it right here and they'll think, oh, let me open up my trade. It's going up. Let me buy. And then what happens is, so they'll buy up here, right? What happens is the market will go back down like this.
Shouldn't you buy bear at that point, though?
You would think so, but you want to actually watch what the market is doing, because the market doesn't just move straight up. How the market moves is actually like this. So it creates these things called higher lows, which I'm going to abbreviate with HL. And it creates these called higher highs, right? So what people see is, okay, it went up, because all you're going to see is this, right? So they say, okay, it went up, let me buy, right? But what you want to do is you want to watch the market, see what it does. So you see it goes down. So what can we see from here? If we only see this much, what can we see is that this higher low is above this low. So that tells us, okay, the market is thinking about moving up. So what we can expect is for the market to move up and go above this high. So if it moves up, it goes above this high. Okay, now we're in profit. And then we expect it to go back down and create a higher low. So a low higher than this low. And it goes down, creates that higher low, and we can expect it to go up and create a higher high. Now, what the market likes to do is when it decides to reverse, this is how you can tell if it reverses, right? It'll go down, create a higher low, and it'll go up, and it won't pass this high right here. And then what it'll do is it'll go down farther than this higher low. And now you know, okay, it's going to reverse. So what you would want to do is you would want to wait for it to go up and create a lower high. So this is a lower high, and this is a lower high. When it goes back up and creates this lower high, what you would want to do is you would want to open your trade because it's a lower high, and then you want to watch it go past this low. And to show you that the market actually moves like this is a trade I caught the other day. So you see it went up, it comes down to this point right here. But this point...
And this is what you predicted on this part, like what you wrote.
So I'm going to show you right here. It came up right here, creating a lower high. I mean a lower...
You can't see from there.
Okay. So it goes up and it comes down, right? And it comes down about at the same point. So I can expect it to come at least back up to this point. So I open my trade right around here, because that's when it comes back around. So I opened up my trade right around here, and it came up, and it came up, and it actually came up above this trade. So now what can we expect for the market to do, right? We can expect the market to come back down to right around here. Right around here.
Create a lower high.
Create a lower high, and then come back up above here, above this point right here. That's how the market likes to move, and actually we can see it from here. So you see it came up, came back down, and came up, creating a high, the same high, and then you see it came down lower than this low, and then it came up, it didn't break this high, and it came back down, right, matching this low. So it came back up and it came above this high. So as you practice with structure and you understand the structure of the market, you can start to accurately assess, okay, this is what the market is going to do, and this is how the market is going to do it, right? But what a lot of traders like to use to make trading the market easier are these things called indicators. Indicators, basically, they tell you the same story in a different way. So one of the most commonly used indicators are moving averages. And basically what a moving average tells you is it takes this many candlesticks. So let's say it's a 50 moving average. It would take the last 50 trades and average it out, and it tells you the direction of the trade. Based off of the last so many trades, right? So what people like to do is they like to use them in conjunction. So they would use, say, a 50 moving average, a 100 moving average, and a 200, right? And the way you can tell what's happening is if the 50 and the 100 is above the 200, and they're all three pointing up, like you see right here. The 50 and the 100 is above the 200 right here. They're all pointing up.
So where are these 50, 100, and 200 coming from?
So you set them when you create the indicator. Like I can show you. This one says MA100. When you set the indicator, when you put on your chart, you basically say, okay, I want you to look at the last 100 or the last 200 candlesticks. So a lot of people like to use 200, 150 because that's just like good numbers, but I've also seen people use like 26, 6, 5. It really doesn't matter how much you use, but a thing you want to keep in mind is the least you use, the smaller number you use, the more it's gonna just move around, and the more confusion is gonna be in the market. So the smaller you want to go is the smallest I like to go is 50. And I like to trade that off the 1 hour chart because that gives me accurate reading. Like right here. You see the crossover, you see the 50 go up, you see the 100 go under the 200, and we see the 50 go under the 100, right? And it's telling us, okay, it's about to go down. So if we only see this much right here, if we only see this much, it's telling us, okay, it's about to go down, right? So what can we do? If we're going with structure, we can wait for it to go down and create a lower high. We can sell because the moving average is telling us it's going down. It creates a lower high, so this high is lower than this high, and we can sell right here. Comes over, comes down, it comes up, but it doesn't quite meet this high, so we know it's going to go farther down, right? And what does it do? It
So
goes farther
in this
down.
case, it would have been a bearish. It would have been best to trade bear. So if I would have bought up here, say, and then trade bear, I would have basically still made profit. Oh, I see what you're saying.
So if you would have
crosses the line, right? Yeah.
So if you would have did a bearish trade right here, you would have made your profit.
Yeah.
So
that would have been crazy. Like over this, that would have been wild.
Yeah, and it also depends on different factors such as your lot size. Your lot size also
What's
depends.
a lot size?
So a lot size is basically you're saying this is how much I want to put up for this trade. This is how much money I want to put for this trade.
Okay.
In essence, that's what it is. So you can control what lot size you use, but it's best not to use more than 1% of your
Show
account.
him what it looks like on your phone. The thing.
So, what would you suggest? Like, if someone is starting out, what would you suggest for them to invest?
What's commonly suggested is about $100. You want to use $100 just to practice, really, because it's a decent amount of money to where you can trade comfortably and not have to worry like, oh my God, I'm about to lose all this money.
Yeah.
But when you get comfortable, you can start with as little as 25. The best thing I've ever did was I had $5 in my account actually, and this was really dangerous trading. So I don't really suggest this, but just so you know, it's possible. I actually had $5 and turned that into 100 by the end of the week, right? But that's really dangerous trading. So what I would suggest is...
why is that dangerous?
Because when it comes to your lot size, you want to use 1% of your account. Well, the way it works is the smallest amount you could use is 0.01, which it sounds like 1 cent, but it's one lot size, right? It's actually like 1,000 shares in essence. But the reason that's dangerous, so this is what it looks like, right? If I open up a trade, this would be my lot size. You see right now I have 0.01, right?
Is that 1%? I mean, 1 cent? Okay.
Well, that's what you would commonly think is 1%, 1 cent.
But it's one trade.
It's actually 1,000 units. So what people will tell you is that's a 1 cent lot or a 2 cent lot, but you have to know, like, okay, this isn't actually 1 cent. This is 1,000 units or 2,000 units, and this same 1 cent, it looks like just 1 cent, but depending on how many pips you catch, which is basically just a measurement of the movement difference between currencies, depending on how much pips you catch, you can make so much money off of it. Like, say I catch 100 pips with 0.01. How much am I going to make? $10. If I catch 10 pips off of 0.01, how much am I going to make? $1. So, go ahead.
So this 0.1 is that 1 cent. So say I'm investing in this right now. Is this 1 cent that I'm investing, or is it 0.68?
What it actually is, it's not 1 cent or 0.068. What this 0.068 actually is that's where it would open up your trade if you sold it.
Okay.
This is where it would open up your trade if you bought it. That's called the spread difference.
Okay.
But what this actually is you're saying you're making an agreement with your broker. This is how we make our money. Is we make agreements with our broker, and we're saying, okay, with this 0.01 cent lot, I want to open up 1,000 units. However much 1,000 units is, I want to open up 1,000 units, right? And your broker will say, basically, okay, we're going to open up this agreement together. I'm going to give you this much based off of your leverage, and you're going to use this much, right? Mm-hmm. Your broker will give you a fee, which is, it's not a lot. Like, for this much, the fee would only be like 5 cents. Mm-hmm. But your broker will give you a fee.
Per trade?
Per trade.
Okay.
Once you cover that fee, then whatever much money you make after that is yours to keep. Mm-hmm. Right? So this actually isn't... try to keep the cents out of your head. What you want to do is you want to think of it as units. So 0.01 is 1,000 units. 0.10, 10,000 units. Right? It's actually, that's how many units of the currency you're actually buying.
Okay.
And based off of how you move this, like you see, I can add 10 to it. So now it's 0.11. Mm-hmm. Right? So if I made 10 pips off of this, I would make $11, mm-hmm. rather than the 1 if I did 0.01. I'd make 11. Mm-hmm. And a 10 pip movement on this chart would actually look like this. A 10 pip movement would be maybe this much. Hold on. That's about a 10 pip movement on this chart. Mm-hmm. So you see.
But that's in the hour.
That's on the hour.
If you broke it down by minute.
If I go to the minute, 10 pips would be like this. 10 pips would be right around here.
Okay.
Right? And depending on how you want to trade will also depend on which time frame you want to look at. Generally, you want to look at all the time frames and get a feel for what's going on in the market. Mm-hmm. But there's different kinds of trading. Like there's scalping, which is when you look at mainly like the 5 minute, the 1 minute, the 15 minute to see what's going to happen within like the next 30 minutes. You know what I'm saying? Mm-hmm. Or you could do day trading, which is what me and Anaya do, which is you would generally look at the 1 hour, the 4 hour, 30 minutes, and 5 minutes to see this is what's going to happen between the next few hours and the next couple of days. Mm-hmm. Generally, those trades, you don't really keep more than maybe 7 hours or so, but you can hold it forever, however long it takes you to get in profit. Then there's swing trading, which is what a lot of people do, which is when you would look at the higher time frames like 4 hours, day, and sometimes a week, where you would open up your trade, like say, you know it's going to come down right to this point, right? You would open up your trade and you would hold it for days until it gets to this point, right? Then you would close it out because you're not really looking for these big moves because it's going to take long. Right? Mm-hmm. So depending on what type of trader you want to become would really depend on which time frame you're looking at. Mm-hmm. But what you want to keep in mind is that all time frames are connected. All of these are connected. They're all telling the same story, just really at different points in time, mm-hmm. kind of. So when it comes to day trading, what I like to do is I like to mainly focus on the 1 hour chart. Right? I would look at the 1 hour chart, see what it's telling me to do. Mm-hmm. Right, I would go to the day, see, okay, is this a downtrend or is this an uptrend? Mm-hmm. Once I decide what trend it is, so like say I think this is a bearish trend, right? I would say, okay, I want to keep the bearish movement. Mm-hmm. Then I would drop down to my 4 hour and I would say, okay, am I in a bearish movement right now? Okay, yes, I'm in a bearish movement. I would want to drop down to the 1 hour. And as you drop down farther and farther, that's how you get more precise entries. Mm-hmm. So I would drop down to the 1 hour. The 1 hour might say, "Oh, you're in a bearish," but it's gonna within the next 5 hours, it's gonna go into a bullish. Mm-hmm. So you might want to hold it. You might want to hold out on trading until the bullish move is over and it goes back into the bearish move.
Mm-hmm. So this specifically, this is euro versus the USD. Mm-hmm. So the euro versus the USD, this is a bearish trade.
Right now, it's bearish. Yes.
So this, I would I would short. I would short this shit. Okay. I'm just trying to get a feel for like how it is. Like,
Yeah, I understand. And once you know, okay, the day is telling me that it's bearish, the 4 hours telling me bearish, and the 1 hour is telling me bearish. That's when you want to drop it down to the low time frames, like the 5 minute. And the 5 minute is probably going to tell you something different. Like it's going to tell you it's consolidating, which is the third trend I actually didn't tell you about, where it just goes sideways. It's not really going up and it's not really going down. Or it could be in a bullish trend. And if it's like that, then you want to wait until it's telling you now it's in a bearish move. Then you would open it up in your bearish move, and then more than likely you'll instantly go into profit because all your time frames aligned and they're all telling you go bearish. That's how you get the really precise entries. And if you can get comfortable using the structure of the market, you maybe find a few indicators that you feel comfortable using and you really understand, and then you connect all your time frames. Then that's when you really start to get your precise entries. You see, that's actually what I'm working with Anaya right now, is to help her get more precise entries, as well as helping her manage her money. Because what I like to think of Forex is not us as day traders, but us as money managers. What we really want to do is manage our money, because you can really have any amount of money in your account.
Made the song just for the podcast, bringing hope through all the smiles and laughs. While you travel through dimensions, I'm talking high vibrations. As you listen to I Am You, yeah, you got that. Yeah, you got that. About to make a mess, so where the mop at? Where the mop at? Listening for more, see what's in store. Your mind steady waiting, do away with Satan. Learn about who you are when you start to fall. Reach through your chest and say, I need more, I need more, I need more. Learn to crawl and learn to move, but be quick, cause Anchor also sponsors me. So I'm giving you I Am You for free. All you gotta do is listen to me. Go and make your own podcast for free. Go and make an episode. Go and fill it with pearls and gold. Give it all your soul. Do things you was never told. I could feel them listening. They on their toes. They on their toes and they want more. All you gotta do, where you gotta go. Go to Anchor FM/start. There you go. Go and get yourself paid right away. It's your money, nobody can take it away. Anchor has sponsors they can use to help you make your move. If you like I Am You, you can also support it too. Thank you.
She was like, I wish I learned that at the age. I was like, it's never too late to learn.
Exactly, because you could always make money as long as you got some money to work with.
Exactly, and you don't even need a line, because leverage, when you find your broker that you like to use, like I use Hugo's Way, and I use Hugo's Way. There's also LMFX, there's JaxX. It's really, you find a broker that you feel comfortable using, you like their system, they get in contact with you, you get in contact with them, and then you find a leverage that works with you, and then that's what allows us as people with not a lot of money to trade, because the leverage is, I'd say, like, I'm putting up $5 and you're my broker, you're putting up 50. So that would allow me to make these big trades, because actually what moves these markets is millions of dollars. One of these candlesticks moves with millions of dollars. And how do these movements happen? It's not because of you and me. I could put in all my life savings, you could put in all your life savings, and then I could put in all her life savings, and the market wouldn't even move an inch. What moves these markets is banks, big corporations, and that's really what moves the markets. You don't a lot of people don't realize it, but banks actually trade in the Forex market. Because all the Forex market really is I want to take this US dollar, trade it for a euro. I want to wait 10 days for this euro to become bigger than the US dollar. I'm going to trade back for $2 US. That's all we're doing, is we're trading currencies back and forth. And that's why it's called the foreign exchange. It goes by Forex for short, but that's in essence all we're doing. So that's really what people don't realize, is that their banks trade in the Forex market. They like to say it's a scam, but the reason Forex seems like a scam is because, as I told you earlier, people want to make $1 million by tomorrow. So they're doing these big leverage sizes, they're using these big lot sizes, and they're blowing their accounts, which basically means they're losing all the money. Because, as I told you earlier, they would open up right here thinking it's a long trade, and it would go down, they would lose their money, they would be upset, be like, oh, this is a scam. So that's why I said we're really money managers, because we want to manage our loss, we want to manage our gain. Like, what we really want is, like, say this is what I'm going for right here. Say I want to go for this right here, just this much. I want to get here. I want to open up as low as I can, but safely. Like, I don't just want to open up at the bottom, because it might continue to go down. So I want to wait till it's showing me, okay, you're actually going up. So I want to open up. So say I might open up right here. Say I might open up at the bottom of this candlestick right here. So I open up right here. All I'm looking to get is up to this point. I'm not looking to get nothing further. That's how I make my money. That's how I get in and get out without taking a big loss. And
it's a 4-hour trade too. Okay.
So just this bit, just up to here, would be a lot of money. Like, it could be, let me see.
Jack, go upstairs.
Let's say I open up right here and I catch all the way up here. That's about 100 pips right there. So 100 pips with $10, let's see. 10.10 times 100. That's not right. Let's see. Oh, no, it would be 0.10 times. It's about $100.
So you put $10 in, you made 100.
You put your 0.10 cent line, and then you would make your 100. You get in, get out. That's how Forex traders make large sums of money in these, like, in a day, like $100 a day, $50 a day. And it's even, like, a lot of people trade with what's called a standard lot, which is 1.00, so $1. $1, I think a 10 pip movement is about $100. And I showed you how small a 10 pip movement was on here. The 10 pip movement is about this right here. Let me see. So not even a full candlestick is a 10 pip movement. You have a 1 cent line. I mean, you have a $1 line. You get that 10 pip movement. You make your $100. You get in and you get out. You make your money. You
and
leave.
then you pay your people, and then. Yeah.
They would get the money first. So say you open up a trade, you might be in the negatives, and then once you get positive 20, they might automatically get their $5 that they ask. And then whatever you get above that $5 is what you get to put in your pocket when you close out the trade. So
they'll take it. They'll take the trade as long as they get their 5. They've made their money.
As long as they'll get their 5 regardless. Whether you win or lose a trade, they'll get their 5. But before you start to make money, you have to cover the fee, the brokerage fee. And the fee will close out when you close out the trade. So say they're asking for $5 for you to open up a standard lot. Once you get $5, you can close that out, and you didn't make nothing, you didn't lose nothing, but your broker made some money. But say you closed it out at $10, you made $5, your broker made $5. So you didn't lose nothing, but you made something. So the higher it goes, the more you make. So say they're asking for $5 for you to open a standard lot, you could hold it until it gets to $2,000, and they only get $5 out of that because that's what they originally asked, and you get whatever else is remaining. So that's how Forex really works.
I'm probably most likely going to do week trading. I'm going to start off with day trading, move out, then and branch out. So as soon as I guess I'm going to start with $50. Right, so I'm going to start with $50. Obviously, so 1% of that would be $5.
What I recommend you do is do your 0.01.
Okay.
Your 0.01 is what's gonna be safe, and that's what I trade with right now because my account is small. I have maybe about $40 in my account, but I trade with 0.01. I say when you feel comfortable, then you could start to raise your lot sizes. Because what you have to keep in mind is trading psychology is the biggest portion of when it comes to trading. That's where a lot of people fail is they see, oh, I'm negative $20, I'm negative $10. Let me close out this trade, manage my risk. Then they close it out. It does exactly what they thought it was going to do. And then they didn't make no money, but they're like, oh, man, I lost $20. So you want to get comfortable trading first with small amounts before you start to trade with larger amounts.
So, like, when I have an account, I could just put 50 on there and not trade 50. Okay. So I can break it down. Like, if I wanted to break it down, say I have $50, I'll break it down into 5 increments or whatever. And then say I make $10 from the 5. Would I be able to reinvest that 10?
Yes, you can.
Okay.
The way it works is when you open up your brokerage account, right? Your brokerage account is basically a wallet. You can put the 50 in that wallet. Then you create little accounts inside your brokerage account, and these accounts is what you trade with. So you could say, I want to take 25 from my brokerage wallet, put it in this account. I want to trade with this 25. I make $50 with this 25. Now I have 75. I want to take 50 from this 75, put it back in my brokerage wallet. So now I have 75 in my brokerage wallet, 25 in my trading account.
Can you explain how to do that?
I can.
All right, because that's where I'm kind of lost right now. Because I don't understand how that works.
All right, I'll show you. It's actually simple. You just have to. It's just really a process to do it. Let me log in.
Jerry, go see.